Small crowd, but I see a lot of energy in the room. We had to really limit the numbers with respect to the SOPs, but I am sure we are going to have quite a vibrant discussion today. So thank you for joining us. I want to reiterate what the comments that have just been made. We need to stick to strict adherence of SOPs in terms of the numbers of people sitting at the tables. Kindly always have your mask on when you're on the venue. We have made provisions for sanitizer on the tables. Please make use of them. If we want to use the facilities, we'll go down one floor to our left, and that's where the bathrooms are. Let me take a few minutes to acknowledge the panelists who have joined us here today, and the media present as well. We have quite a few journalists, colleagues, and who are going to be joining us online. So introducing the panelists, and I'm sure the moderator is going to welcome them to join us at the appropriate time. We have Adolfo Alonso, Program Manager with the EU. We have Keith Kalyagira, the CEO of the Capital Markets Authority. Rashmi Pillai, the Executive Director of FSD Uganda. We have Ruth, Program Director from PSFU, who's going to be joining us online, and Richard Mugera, who's part of the steering committee for the East Africa Venture Capital Association. Thank you all for joining us here today. As I mentioned, we are a small crowd, but we are looking for very vibrant and engaging discussion about how we can bridge the gap in access to long-term finance for a stronger private sector-led growth in Uganda. So without further ado, I'm going to welcome my colleague, Jackie Chitibwa, who is the FSD Uganda Head of Business Environment, and who's going to be taking us through the next part of today's program. Jackie, welcome.
Country Director of Asset Capital in Uganda. Lastly, I'll invite Ms. Rashmi Pillai, the Executive Director of Financial Sector Deepening, to please take a seat. It is a pleasure to have you all here with us, and I appreciate you for accepting our invitation. The goal for our next hour is to examine how players and partners in the capital markets ecosystem can promote investment in medium-sized enterprises in Uganda. We will have 1 hour or so to allow the panelists to share their thoughts, and this will be followed by a Q&A at the end of the discussions. So for those online, please feel free to send in your questions as they come up in your minds, and keep them fresh so that we can provide the panelists some time to respond to these questions. Just to set the stage, over the past 20 years, the African capital markets have evolved quite significantly and continue to play an important role in providing capital to businesses to support growth and create sustainable impact on the continent. The 2020 annual private equity data tracker shows that the total value of reported African PE deals for the period 2015 to 2020 was just over 2.17 billion, with a corresponding volume question all the time. Where and how do we find enterprises with high growth potential? Not only in the short term, but how do we ensure that there is a pipeline producing investment opportunities over the long term? On the other hand, users of capital want to know, how do we position ourselves to become investment worthy and attract financing? And how should market intermediaries and other ecosystem players support this process? These are some of the elements that we will need to consider as we delve into this topic. Issues around affordability of transaction advisory services, business skills for enterprises, existing information asymmetry, quality of investment opportunities, market structures, and infrastructure. So it is around these areas that we will focus today's discussion on the questions that we all face as industry, government, regulators, and development partners. So today's panel discussion is threefold. First, we want to understand the challenges and opportunities that exist in our markets in the investment space, explore the role of the regulator, development partners, the private sector, market facilitators in ensuring that we do have a strong pipeline of investment opportunities. Lastly is to understand how this tripartite partnership between CMA, FSDU, and EU will help address some of these challenges identified. So with those few thoughts out there, I think let me throw it to Adolfo to kick us off and just share, provide a background on the European-Ugandan partnership and the Sustainable Business for Uganda platform initiatives. Thank you very much.
Thank you, Jackie, and good morning to everyone. Well, actually, the alliance between the European Union and Africa for sustainable jobs and investments is actually related to the SDGs, to the Agenda 2030, and to be able to manage to mobilize an amount of capital that some sources they mention that is like $3.9 trillion in the next now 9 years. We're in 2021. So to mobilize that amount of money is not enough only to mobilize development kind of funds, but it's also needed to mobilize the private sector. And that is what we have been working on. I mean, from one side, the Ugandan government already have different strategies, private sector development strategy, companies from private sector. In this case, the umbrella organization that is part of the platform is Private Sector Foundation Uganda. They are co-chairing with the European Union with the involvement of the government. So the idea is to have that platform where the dialogue between private sector and public sector happens, and we are able to monitor the different programs that they are being supported in Uganda.
Thank you very much. Well, I think I will now ask Keith to just share. We are aware that CMA has launched its new strategy for the next 4-year period. We just want you to share some of the key objectives of the strategy and what it is you want to see in the next 4 years, but also looking back and seeing what has been achieved in the past 5 years and how some of the challenges you have observed are going to be addressed by the new strategy.
Thank you very much, Jackie. Good morning, everybody. Good morning, listeners out there and viewers. Yes, we're very proud to associate ourselves with this initiative by the European Union, who wisely selected FSDU as the implementing partner. It's something we've been thinking about as the Capital Markets Authority for several years, and we're glad to see that this has actually come to fruition. I mean, really, we have been asking ourselves the question of how to bring those who need capital together with those who have the capital in a meaningful manner. And here we're talking about both domestic savers, long-term savers, and foreign-based long-term savers. We're not talking about the short-term savers, which is mostly the domain of the banking sector. We recognize that the economy needs long-term patient capital. Doesn't have to always be based and backed up by collateral. So really, we're just trying to do our best and make our contribution to realizing our vision and this has really been underpinned in the strategic plan of fostering inclusive growth. And the word inclusive was added deliberately because we recognize that we're operating in a country where there's a fast-growing population, young population, who are eager to be entrepreneurs. We have continuously and consistently ranked very highly in terms of entrepreneurship as a country, and we recognize that the need to respond to this demand for matchmaking services. So we see this initiative really as a wonderful stepping stone to realizing this dream. Our strategy has 3 key objectives about improving the strengthening the institutional excellence of the CMA as an organization, helping to raise awareness amongst both investors and issuers about the availability and benefits of market-based financing, and also protecting investors. We ultimately want to make sure that the people who we license are operating professionally, ethically, etc. But the main thrust is really going to be about how to develop other forms of market-based financing. And we're thinking about domestic private equity, because most of the private equity operating in this country is, raises their capital offshore. But we also recognize that the growing pools of domestic savings that need to be channeled into the real economy. And this is where we believe we need to all lean on the effort of establishing an environment or framework that allows domestic private equity funds to be established in an efficient manner, in a tax-efficient manner, to help channel all this money in the NSSF and other retirement benefits. We recognize that savings are growing at a rate of about 20% every year, and we expect these savings, this pool of savings, to be at about 30 trillion in the next 5 years. So these savings need to find a home. Right now, we're aware that the biggest sort of borrower or user of these savings has been the government, which has been the most consistent issuer of securities. But we believe there's space for the private sector to also issue securities, whether they're debt or equity securities, in order to tap into this capital to finance the growth of businesses so that more jobs are created. And we also recognize that as more jobs are created, there are more people who can use financial services. More people can save for retirement, can save for investment, can insure their goods and services. So it's a whole chain reaction that we want to be a part of developing. On our part, we want to be a lot more efficient when it comes to regulatory responses. For example, when it comes to reviewing regulations for collective investment schemes, for offering of securities, private placements, private equity, we want to be a lot more responsive, and hence the need to be more efficient when it comes to revising or reviewing the relevant laws and regulations. I think I'll pause at this point.
I'll now throw the question to Rashmi. Rashmi, if you could just provide a background of financial sector deepening Uganda and some of the work it has done in the past few years, and how this all fits in well with our plans around long-term based financing.
Thank you, Jackie, and good morning, everyone, both online and here. So I'll give a quick background on FSD Uganda for those who are not familiar. FSD Uganda is the country's premier financial sector think and do tank. Until recently, we had a more supply-side focus of promoting the growth and financial market development. So to give you examples, we have a big portfolio of work on an enabling business environment where we work with every single financial sector regulator. A second portfolio is on how do we create, how does money and information move in an economy, and how can we make it move affordably, seamlessly, and what are the rules that enable that to happen? And the third portfolio of work that we've done is on giving catalytic grants and other types of financial technical assistance to innovations in the market, innovations that answer questions around why is retail formal insurance very low in Uganda? How do we increase the penetration of credit? How do we increase and prove that refugee financing can grow? And all of these are targeted at our beneficiaries, which are youth, women, refugees, small and medium businesses. Now, in our new strategy, which is actually starts this year, so 2021 to 2026, we have realized that true financial depth and real growth needs both a supply and a demand side approach. So we are working with companies, with sectors that have the highest employment multipliers to see what is the role of finance and how can finance enable the achievement of the SDGs that we heard Keith and Adolfo mention. Coming to the deal flow facility, in particular, the deal flow facility addresses the three objectives that Adolfo mentioned, and Keith touched upon it very adequately. One is the mobilization of capital into high growth companies. Second, the technical assistance for companies to become investment worthy and attract more capital. And third, an enabling investment climate. So the deal flow facility through has a couple of objectives. The primary is to increase access to non-bank financing into high-growth companies in Uganda. And the developments of the deal flow facility, the capacity building that it provides, the lessons learned from companies and investors that are part of the deal flow facility will be very useful fodder, if I may call it, for the Capital Markets Authority to continue to do its role as a regulator and build a stronger investment climate in the country.
Thank you very much, Rashmi. I've been told that Ruth from the Private Sector Foundation is online. If we could just have patch her in right now. Okay. Ruth, if you could just tell us
Yes, good morning, everybody. I am saying that I guess my video cannot be seen, but I have to say, coming from the Private Sector Foundation Uganda, which is the apex board of the private sector, we are very glad that this event is happening today. It is a key milestone that we are launching the deal flow facility. And as PSFU, we have worked closely with the EU. As you are aware, the EU are partnered with the private sector in Uganda to form the SB4U, which is the Sustainable Business for Uganda. And in this, we are able to bring together both Ugandan local businesses and also EU businesses that operate in Uganda. And I have to say, one of the biggest challenges that they have been able to raise, the private sector, is the issue of access to affordable long-term finance. And we do believe that today is a key achievement for SB4U, and we would like to congratulate the EU for supporting this particular initiative. You all have to note that out of the top 3 challenges that the businesses are facing, access to finance is among the top 3 challenges. And with the innovation of the non-bank financing, to us this brings a large opportunity, especially to small and medium enterprises in this country, because as you know, banking financing using the conventional means, the normal means that is extremely very expensive. It requires a lot of requirements, asset security, which a number of smaller businesses cannot afford. We do believe that this particular initiative today, the Deals Flow Facility that has just been launched, is going to be a key milestone. It's going to be another additional strength in supporting the various businesses that we have in this country. And I want to pledge the support from the private sector, led by PSFU, in ensuring that this is able to be materialized, but also to encourage a number of businesses, both medium and small, but even large, to be able to utilize this particular opportunity. I want to thank you all, and I want to request you that this information is able to be disseminated and understood. We would like to pledge as PSFU to even have a particular forum where you can actually be able, through our SB4U platform, whereby we can be able to further engage the particular beneficiaries of this particular facility. I want to congratulate all of you, and I'd also like to send our regards from our chairman of the board, Honorable Enika Ruhanga, and the executive director, Mr. Gideon Batagawa, who is very sick down, and we pray that he gets well soon. But as PSFU, issues concerning access to finance are very critical issues, and where now we are looking at non-bank innovative financing. To us, we think we are moving in the right direction to ensure that we support businesses in this country to be competitive, to be able to take over the market, both in the region but also international markets, to be able to support the manufacturing industry that has been grappling with affordable finance. Thank you very much.
Thank you, Ruth. Maybe just a follow-up question to some of your remarks. I just wanted to know, you mentioned that access to finance is one of the greatest challenges for small and medium enterprises in Uganda. I just wanted to know, what are some of the initiatives PSFU has been doing besides the SB4U platform work with the EU, what are some of the other initiatives that PSFU has been providing to its members?
Okay. Maybe one of the things I have to say, and I think being from FSDU, you recall very well that the Credit Reference Bureau was a baby from PSFU. We started it with support from the World Bank, and I think one of the issues we had by that time was we thought that it was becoming very hard for businesses to access financing, and the banks had issues on getting more information about their clients, the cost of financing. And one of the issues we came up with is the Credit Reference Bureau. The Credit Reference Bureau support came actually from PSF. It was under the private sector deepening projects, which where we got money from the government and the World Bank, and it was started. I know that we've also worked with you as PS in supporting the land, support all the money in this country that has come to support the land information system has come through PSFU. Government, we lobbied government, we worked with them, we got additional financing from the World Bank, and right now you're able to access in a very short time. You're able to register land, you're able to access, there was a lot of land duplication, and that was an issue in accessing finance, which was a very, very big challenge. And the land offices, you see, we had very few land offices. Through PSFU, we actually worked with the government, we lobbied to ensure that we have more branches of the lands office, because land is a key issue for this country. We are currently going to work with NITA, because NITA is taking an initiative on data integration. We know that sometimes if you want to deal with anybody in business, you want to know so much about them in a minute. If I want to know your land title, I want to know the businesses you have, I want to know the various assets that you have, I should be able to do it. We should be able to have a system where we are able to link what NITA has with NILA, with the Financial Intelligence Authority, with the Lands Information System, and that is where we are going. PSF has also been so keen on training in financial literacy. We have worked closely with the Bank of Uganda and some of the banks like Centenary Bank to ensure that it becomes so easier for people to understand issues on financial literacy, because those are also issues. Those are issues that we have found that are actually affecting businesses. And I know that Capital Markets Authority is there, but we've worked so closely with you. Capital Markets Authority is actually a member of PSFU and the Uganda Securities Exchange, and we are behind it. If those of you that can recall the Morana's time who passed away, he was so keen on ensuring that the private sector is able to appreciate issues concerning the securities market. And we are so closely looking at that. When it comes to the various financial bills, we're also looking at it. So as PSFU, we're actually taking a center stage to ensure that the private sector is able to access finance. We are also glad that the EU has been able to revamp, putting some resources in UDP, but also as PSFU, we've been able to lobby government to be able to put in more funding in the Uganda Development Bank to ensure that Uganda businesses are able to access long-term and affordable financing. And for us, the deals flow facility is another game changer, because the money in UDP is not enough for the businesses. I can tell you, the applications they have, the demand is much higher than even what they can afford. So if we can actually be able to be innovative enough, like what is happening today, and we look at other non-bank financing opportunities, this to us as PSFU is an achievement. And I want to say we are not taking it for granted. We want to ensure that more businesses are able to understand it, appreciate it, but also use it. Apart from launching it today, we need to have more being able to open up and be able to use it as well. Yes, thank you.
Thank you very much, Ruth, for articulating the needs and all the work that PSFU has been doing to support its members. I will get back to you with a few questions later, but I think right now I'll throw it to Richard to just, first of all, we are aware that the East African Venture Capital Association launched its Uganda chapter a few months back. So if you could just tell us about some of the work that EFCA is doing in the region, and especially what the Ugandan chapter plans to do.
Jackie, good morning all. For our audiences that are not here, first of all, We need to recognize that the pandemic is real. And so stay where you are and stay safe. But yes, the East African Venture Capital Association is basically mandated to bring stakeholders in the, with private capital together, to create a forum for those with private capital to be able to network the regions where they are. It started as an Africa-wide association, and when we look at Africa and private capital, usually we think of Cape Town and Johannesburg and Cairo. And then after some years of networking and you know, capital looking for places of opportunity, it moved into the East African region. And when we think of business industry, we think of Nairobi as a capital for the East African region. So it moved as an association and chapter to Nairobi. And the East African Venture Capital Association, Nairobi chapter, was very, very instrumental in pulling together and bringing together capital in this region. You spoke about some hefty numbers, $2+ billion US. And we've heard Ruth of PSFCU say that as a bucket of funds that they have is not enough for, you know, the companies that are looking for private capital. So that's one of the areas of the East African Venture Capital Association, is to attract capital into this region. And we thought, as the founding Uganda chapter members, that if everyone is pulling capital to their capitals, why don't we? We need to be a voice for Uganda in terms of attracting capital. And therefore we thought that, you know, us who are fund managers in Uganda should actually be able to attract more capital into this area. And for the last 3 years, 2 of my colleagues and I have been working and basically lobbying the Venture Capital Association of Africa and East Africa to have a chapter here in Uganda. And with the pandemic, you see now why this is very important, because you can no longer fly around Africa as we used to. You can imagine now if the PSFCU needed capital, or if FSD needed capital, and you needed someone from, say, the European Union here at Dofo to fly in from Paris, it's going to be difficult. But what they can do now is count on, you know, the association to pull together intelligence information on the companies that they want to work with, institutions that they want to work with, to do and gather intelligence and due diligence information for them. They no longer have to be on the ground to access these companies. So that's what the association will do. The association will pull together information to be able to share with all the stakeholders. The association will pull together those with access to funds and those that need the funds to be able to socialize, engage, network, and find mutual ways of accessing each other. So we make it easier to network and bring stakeholders together. That's what we hope to do as a Uganda chapter of the East Africa Venture Capital Association. And what you could do in your own desks, in your own offices, is to encourage different stakeholders. It doesn't have to be companies that are looking for capital alone. It could be professional services. We have many good lawyers. We have many good accountants in this country. We have many good analysts who don't have access to what developmental finance institutions are looking for. if you look at the European Union is one of the biggest investors in this region. They pool their money and invest, put their money into fund managers. Fund managers with local knowledge look for enterprises that fit into the criteria of safety for investment. And then this money trickles down into the private sector. Without the knowledge that we have good professionals that can actually perform good due diligences, that can perform good management for these portfolio companies, follow-ons, and so on and so forth, then you do not take advantage of it. So we are looking to FSD, PSFU, CMA, and all the other partner associations to encourage their members, stakeholders, to register with East African Venture Capital Association, to be a pool of knowledge to take advantage of private capital, how to manage private capital, how to keep it safe, grow it, expand it, and scale it. That's what we're looking to be and to help with the partner organizations that we have here.
Very much. I think I'll get back to you with a few questions on challenges that investors face in this market a bit later. But I think before we go into the challenges and opportunities, I just wanted to throw this question to both Keith and Richard about what your observations have been around the growth in private equity and venture capital deals, capital flows right now in the East African region and in Uganda. And what do you foresee, how do you foresee this growth coming up in a few years?
Thank you, Jackie. Private equity, the evolution of private equity. By definition, it's private capital, and sometimes that even extends to the privacy of some of the deals. This is oftentimes not public information, especially during the time when the due diligence is going on. I think there's sometimes a view that, businesses don't want to be out in the public, being known as seeking capital. So a lot of deals have been happening. Some of them we're aware of. For example, Bujagali was financed by private equity. I think DFCU at one point was financed by private equity. So there's several big ticket deals that have been going on, mostly from capital mobilized from outside the country. I think that now the real issue is how to have a local presence, and as Richard was saying, bringing in local professionals, developing those skills to source and execute deals is one of the key things we need to focus on if we're to really see this industry grow. And as I said earlier, the real challenge is how to channel domestic savings into the private equity space. Right now it's been dominated by foreign savings, and it can't always be, and this is really a challenge the fund managers we license, that it can't always be investing in government securities and the few listed securities in Nairobi and Kampala that are available. It's got to be channeled into the real economy if the capital markets ecosystem is to play a meaningful role in helping to develop this economy. As a regulator, we've got both mandates of development and regulation. And there's several things we've been trying to do, which can be construed as a bit of a contradiction. Because if you're going to be trying to focus on regulation and development, the two sometimes can result into a bit of tension. So we're really happy that the deal flow facility is being established, which is going to handle many of the tasks that we've been trying to do as a regulator in building capacity and encouraging the people we license to go out and initiate transactions. We've been running several corporate governance series on how to make businesses aware of what they need to do from a governance perspective in order to be more attractive to raising market-based financing. We've been running series on even valuation of businesses. How do businesses valued? And these are skills that are required across the board. So I believe there's quite a lot of interest. Look at private equity. Many of the listed companies in some jurisdictions in the world are actually getting delisted because they prefer to get financed privately by private equity. So we have to recognize that there's a growing interest. I think about 10 years ago, there were only about 600 private equity funds globally. Now there are over 6,000. So there's something that's going on in the private equity space that we need to pay attention to. Thank you.
Could you comment on that as well?
Keith, for those comments. I want to tell you that, if you look at East Africa, for example, and how much capital has come in, private capital has grown by over 7.5 times in the last 6 years. It's growing twice as fast as public capital. So governments are able to bring in capital to invest in different sectors for growth, especially the highest sectors of growth. If you look at Uganda, for example, we're looking at natural resources and agriculture. If we look at this year alone, with the signing of the final investment decision by, Total and the government of Uganda to extract and process oil, that's foreign capital coming in, and they've been able to attract that. But think about this. Private capital grows 7.5 times much faster than public capital. And that's a big number. So it is important to have those synergies between public and private actors to manage this capital. And if you manage it well, it will grow. So there's growth there. If you look at our fund, Ascent Rift Valley Fund, which is a very young fund, we started fundraising in 2013. Our first investment was $80 million. If you look at by how much we've grown over 40% from our first fund to the second fund, from $80 million to $120 million just this year. So you see that that's really, really good growth, and it's fast-growing fund growth. And there's many funds out there that are attracting capital, but they'll only attract capital if it's managed well, if the companies that are being invested are managed well, and if organizations like your own, FSD, and many others that are being funded by UK aid, by EU, and they have to fund them because they're the biggest investors. They need to protect their capital. So they have to make sure that we have professionals who are available to manage and ethically grow and scale these funds when they get invested in local companies. Yeah. So growth is there, absolutely.
I will get back to you to ask you about the role of market intermediaries in the work that you do. But before that, I know that the EU has set up a number of funds to support businesses in Uganda, and one of it is the Yield Fund. I just wanted Adolfo to just comment on some of the capital flows that the EU has made in Uganda and what key observations or lessons he can share with the audience today.
Thank you, Jackie. Well, let me just maybe continue with what Keith and Richard were talking about the flows of capital into Uganda, capital markets. I think that we should not forget also about the stock exchange itself, because capital markets is both stock exchange and private equity funds, venture capital funds. So in terms of the stock exchange, I mean, we have not seen actually a big change, to be honest. I mean, in the last years, there have been very few listings. The capital that is actually invested through the stock exchange into companies has been stagnant. And actually, sometimes we need to compare what is the actual situation of amount of money in the stock exchange in Uganda. That is around, I think in the last statistics, is around 5% to GDP. And we have to compare actually with other countries. I mean, it's not a question of always be comparing Uganda to countries like USA or China or European Union, but we have to do it because we have to understand why sometimes the private sector doesn't get the kind of support that they get. So countries like US or China, they're about 100% of capitalization of stock exchange to GDP. European Union is around 90%, if I don't remember wrong. So there's a big difference because we're talking about above 100%, and in Uganda it's around 5%. So that means that there's a lot of room for improvement. And honestly, I'm not saying that just to say, oh, you see, Uganda is not developed. It's not that. I mean, it's just trying to understand what are the possibilities of growth. So from that side, we have a lot of room for improvement. And actually, I would say we're also missing an opportunity because there are a lot of SMEs that they could be listed because there is that provision in the Uganda Stock Exchange to list Ugandan companies, and it's not happening, actually. I mean, the provision is there, but the money is not being released to SMEs through the stock exchange. On private equity venture capital, just maybe to be a bit clear to the people that they are following us, I mean, what do we mean by that? We mean by that like funds like the one Richard is heading that has different products for SMEs. Mainly is loans, long-term loans, that they are a bit different from the bank loans because they are longer term, and then you have the support from the fund and the fund managers to improve the performance of the company. Sometimes you have convertible loans that convert eventually into shares, and eventually sometimes you have shares as well, equity that is bought. Although in East Africa, it's actually something that is not happening. We will come maybe to that later on. What are the reasons why many funds, they don't invest in companies through equity, but anyhow, these are the kind of products that normally they are available. Many of these funds are domiciled outside of Uganda because of many different reasons. I mean, protection of investors, taxation, etc. And as Richard was saying, yes, we have seen a number of new funds in Uganda, a number of fund managers that they are now domiciled or set up here in Uganda as well. So yeah, we see a change from 6 years ago to now. I think that is what led actually to the setup of the East African Venture Capital Association chapter in Uganda, because now you have at least a critical mass of fund managers and funds operating here. So for many different reasons, it's good to have that kind of association, is to also advocate for the improvement on the space of private equity funds in Uganda, but also to raise awareness to companies that kind of capital is available. So I'm actually very happy that Richard is saying that there has been an increase, because yes, I mean, actually that is what we are trying to capitalize in. I mean, there is more funds and more capital available for Ugandan companies to make use of it, because the capital is there, but sometimes it's not deployed because some companies, they are not able to access that capital, and that is what we are trying to support with this deal flow facility. The reasons for not being able to absorb that capital that is now available through private equity funds, I mean, it varies, but sometimes it's because family companies are not used and they don't understand what is this. They are more used to get money from the bank, typical loan from the bank, short term, high interest, and that is what they are used to, and that is what they know how to get. So they get stuck into that. Sometimes also we don't have advisories that support those companies to know how to negotiate with funds like the ones Richard is heading, or eventually sometimes we have governance problems with those companies. So there are different issues, but the reality is that capital is there, and sometimes now what we are not being able to do is to be able to deploy that capital into Uganda. I mean, sometimes that capital is going to other countries in the region, and that is what we want to avoid, and that is what we want to support. So, yes, few years ago, we realized that there is a demand from companies to access this capital, and we ended up investing in Yield Uganda Investment Fund. It was set up in 2017. We co-invested with NSSF, actually something that we're very happy to see, because pension capital fund being mobilized for private equity is something that we are not seeing very much in the region, and especially in Uganda. So to see that happening, co-investing with NSSF was a very big step for the fund. And then eventually we also attracted some capital from impact investors from Finland and the US. So set up the fund. Now we are investing in different companies, but we see firsthand what are the kind of challenges that our fund manager has to be able to deploy the capital, because of the several reasons I've been mentioning before. Some companies are not ready. They don't know what is actually private equity. So based on the experience, that is also why Capital Market Authority wanted to support this kind of facility, and that is why we jump in and say, okay, let's partner with with FSDU, with Capital Market Authority, and let's make this facility happen. So that is a little bit what's happening there. Yeah.
Thank you, Adolfo. I think that leads us seamlessly into our next discussion. I think you have well outlined some of the challenges that we see with businesses. And I think my next question would be, you mentioned, I think let's take a step back. I think most of us here at the table are discussing the lack of access to finance as one of the limiting aspects of business growth. But we all know that sometimes entities, it's not the lack of access to finance that actually stops their growth. There are other underlying issues. I thought if Rashmi, you could comment on that. What other non-finance challenges that businesses face that could be inhibiting their growth? And then I'll ask Keith to comment on that as well.
Sorry, Jackie, before I come in, maybe we can ask Ruth to also speak to this question on what she sees as some of the challenges that PSFU's members suffer, which are non-finance related. I don't know if we have Ruth on the line still.
Is Ruth still on the line?
Yes, I'm there. I
Thank you.
wanted to also say something on what Adolfo was saying concerning why the private sector is not utilizing the private equity funds option. I think one of the areas we need to increase support is creating awareness. He talked about ignorance, and it is true. A number of businesses, I sit on boards of 3 companies, medium-sized companies, and these are family businesses, large family businesses actually. If I name the companies, you'll be able, probably you've been in one of those hotels if I say it. And what normally happens is that a number of, owners of Ugandan businesses are ignorant. If you tell them private equity, they don't differentiate it. If you say private equity, joint venture, if you talk about stockage and all, they don't differentiate it. And then some of them think there is no flexibility. They know if I go to a bank, I'll be able to negotiate. And they just think that maybe for these other non-conventional ones, the flexibility is not there. And then they also think they will lose control of the ownership of their own businesses. So it's very, very important, as if we want to make this work, I think we also need to create money, put aside a certain budget for creating awareness. We need to do that not only here. When we do events like this, probably we are speaking to a smaller audience. I think we need to think a little bit beyond the box to see how do we ensure that the people we're actually targeting are able to understand and be able to utilize these various opportunities, because the demand for financing, the demand for capital long-term financing is real. It is real. We have this opportunity, but how do we ensure that the private sector that are intended to use it are able to use it and appreciate it? Now, the other challenges that the business is actually facing is, apart from access to finance, we have the issue of skills, human capital. And I think we have been grappling with this issue with the government, but also with the EU and other development partners, whereby, businesses have, even if you have the financing, you have the equipment, but we have workers that don't give us what exactly that we need. A number of people in the industry have been having challenges of having workforce that come in and do not meet the expectations. They cannot be able, the education that we have in the country that is not meeting what they need. You have an engineer who's an agricultural engineer who cannot operate a tractor. You have somebody who comes in to work in a factory who is a machine operator. He has had a diploma in one of our vocational training institutes, and he comes into a factory, and the guy has never seen a machine at all. So that is one of the issues. The other one is the issue on when it comes to innovation and product development. That is an area where there is a lot of support. We have, especially for smaller companies in manufacturing, in agro-processing, they have a lot of interest in adding value. And a number of times there is need for support. That is an area for where it comes to technology acquisition and innovation. It is one of the areas actually where it is really affecting the quality of the products that is coming out. And I think if we look at support or intervention in such areas, we think that actually could play a very big role. The other bigger issue, which I didn't talk about, is the cost of electricity. The cost of energy that industries use in the region is still a little bit high. And guys, we have now COVID. with COVID, because of the curfew, the hours of operation, the companies cannot operate the 3 shifts. Because before, you could have workers starting at 7 p.m., they will end at midnight. You have another people starting at midnight, and they will end at 6 p.m. Now, the lower rate normally starts from around 11 to 6 a.m. in the morning. Now, because of curfew, the companies cannot manage the 3 shifts. And because of that, it is actually extremely very expensive, even without curfew. Still, the companies, we are finding the cost of energy as a very big issue for them, and I think we need to seriously look at that. It's an issue, and I think we need to look at it, and we need to look at it very seriously. We also have sectors whereby there is double licensing or taxation. For example, the tourism industry, where you find them paying maybe 3 different licenses at the same time. And we are trying to work with URA to see that there is harmonization. That is also a very key issue. For some sectors, we need to harmonize some of the licenses from the local authority with URA. And I've given an example of the tourism sector as well. Now, as PSFU, there are also general issues concerning the regional market. You have been seeing how we've been struggling with exporting our products to Tanzania, to Kenya, and these are real issues. If we are talking about integration, if we are supporting our businesses to be more competitive, to produce a little bit more, to be able to export to our neighbors. Milk, we've had issues on the milk, we've had issues on our poultry, we've had issues on our maize. There are 2 strong issues here. One could be on the issue of our neighbors creating non-trade barriers, which sometimes are not justifiable. You might say that, okay, fine, our maize is not good. Yes, we do agree, but let's talk about labor, where it is easier for people from East Africa to come and work in Uganda. But it is not very easy for a Ugandan to go and work in other East African countries. So for me, for the private sector, we think that is something that we need to really look at and see. How do we ensure that it is much more easier for all the countries? If you are able to sell your products in Uganda, let's also go and sell ours there. But also, we also know that the issue of the quality of the products, the aflatoxins and other issues are also real, whereby, farmers have challenges with, post-harvest handling, issues with storage that compromise the quality of the products that we are selling, that I think we also need to look at. So I think that, and also maybe the commercial court, we have issues with the delays. If there are delays, for example, if businesses had something for litigation, it takes a very long time to sort out a legal issue. If you had an issue with your supplier, with for example, in a contract as a business, we still think that the commercial court it takes time. It takes time to resolve some of these issues, which indirectly affect also the cost of doing business. So I think in summary, those are some of the issues that we are looking. And long-term financing, I already talked about it. I don't have to repeat that one, because that one is also a key issue as well. And I think also governance and corruption is a key issue that I also need to talk about, because a number of businesses we sampled, all of them indicated, almost 60% indicated they had been involved in a case where they are requested to either pay a bribe or be involved in paying something to ensure that their contracts are able to move when they are dealing with government. And that is the reason why I am glad that with the EU under SG+, we are trying to look at governance, we are trying to encourage, we are going to set up a private sector corruption reporting facility to ensure that the private sector are able to share their challenges and then own instances of corruption, but also be able to engage the government on improvement. We are going to come up with the private sector award, the anti-corruption award annually, to recognize government agencies that are doing
Sorry, Ruth, we seem to have lost you, but thank you so much for spelling. Sorry, Ruth, it seems we have lost you, but thank you very much. I think you have clearly articulated some of the problems that are being faced. Some of them might not be well addressed in this forum, given the people that we have on the panel, but we will concentrate on those that we feel are within reach of the different stakeholders that are here. And I think I'll just throw this question now. You mentioned issues around business skills, governance, awareness, innovation and product development, and a few others that were mentioned by other panelists. So I think we do have less than 10 minutes for this session, so I'll just ask us to delve now deeper into the DFF and how we see it fitting with around the discussions that we've had, what we think it will achieve, and how it will come in to address some of these gaps and some of the friction that we see among the different players. So I'll ask Rashmi quickly, if you can just spell out, I know you mentioned this earlier, but if you could just provide a deep dive into what the DFF will do and how it will address some of the challenges that have been discussed here.
Thanks, Jackie. I plan to also address that in my speech later, so I'll keep this brief. I think just to continue with Ruth's point, there were 4 big issues that she raised. One is the cost of doing business in Uganda is very high. Second, she talked about the product competitiveness of what Ugandan businesses are producing and how they can compete regionally and internationally. Number 3 was around litigation and the challenges around litigation that businesses face, and the 4th was around formalization of these entities and making sure that they have better governance practices, accounting practices, and are ready to take in investment. So the deal flow facility probably cannot address all of the issues that she has mentioned. It will be able to address a key issue on how do we make Ugandan businesses more investment worthy, especially targeting around issues of governance, issues around talent, issues around accounting, and making the business more organized and attractive for investors. We can also, the deal flow facility, because by virtue of being a matchmaking facility, will also partner with IVACA, which is the East Africa Venture Capital Association, the Africa Venture Capital Association, and others to attract them to the facility. So there is both supply and demand matchmaking that the facility does. Yeah, thank you.
Just talk about the enterprises that the deal flow facility plans to work with. Who is eligible and
so the deal flow facility will, the ambitious target that we have set for ourselves is 40 deals in 5 years. This can be equity, debt, quasi equity, any type of financial instrument is in play, and it is sector agnostic. So the deal flow facility is accepting of all types of enterprises, but mostly medium to large enterprises. So the type of financing that these companies that apply to the deal flow facility should at least have the absorption capability of $500,000.
Thank you very much. I'll just ask Keith to mention how we know that the CMA has put in place an issuers program and is working with issuer resource persons, and we see this work closely knit into what we are trying to achieve with the DFF. So if you could just speak to that program a bit.
Thank you. Yeah, indeed, the issuer resource persons program was an intervention by essentially getting those who are knowledgeable on how to prepare companies to access market-based financing to go out and speak to these companies. So we really see this as a strong complement to the deal flow facility. We might even just pass on the entire program to the deal flow facility, but initially we should work closely. Because ultimately our interest is seeing deals closed. Rashmi just mentioned 40 deals. That's 8 deals per year. That's not an easy feat, because in order to close 8 deals, and Richard could tell us, you might have to look at about 100 companies, maybe 50 companies, and take them through a filter before you can eventually sign the term sheet and the financing agreement. So it's going to be a lot of work to do, but I think the partners behind the FSDU are strong partners, and I think if there's one agency or entity that is best suited to do this, it's FSDU. But of course, we shall support FSDU as much as possible. I know we're going to be part and parcel of many of these processes. Training people on valuations, training people on corporate governance, as I mentioned earlier. I think as Alonso was saying, it's not about the absence of capital. It's about the absence of knowledge on how to access this capital. There's more than enough capital out there. But the question is whether the businesses know how to access it and how best to address the fears they have about accessing this capital. Sometimes they're even not sure how to negotiate good deals. Now, because private equity has been at it for much longer than the businesses, they feel they're in a weaker position. So we have to really build the entire ecosystem together with FSDU on how to get intermediaries, trusted intermediaries, to intermediate on behalf of the businesses and get a win-win solution, both for the private equity funds and the businesses. You know, the fear of takeovers and loss of control, it's real. How best do you get advice? And, you know, because we haven't had too many deals done in this country, you won't find, you know, a lot of capacity out there. So we need to really build the entire ecosystem. It's not just about closing deals, but it's about sustainably building the entire ecosystem. And that's why we partnered with the Chartered Institute of Securities and Investment to help build capacity. So it's really a chain. It's a comprehensive program that we hope will see positive results in the next, you know, in the medium to long term. I don't expect that to see deals closed in the first 2 years. So I suspect the bulk of the deals will be closed in the subsequent half of the 5-year period. But if you take a step back and think about how much private sector credit is disbursed every year by the banking sector, I think it's anything between 1 and 1.5 trillion. So over 20 years, that's about $25 trillion disbursed. We're not talking about a lot of money here. $500,000 per deal, there should be more than enough companies out there. And we need to associate with the banks also. I think the deal flow facility needs to associate with the banks through the Bankers Association. I know there's issues to do with privacy, you know, client confidentiality, but there must be a way in which the banks can share information with the Private Equity Association, with the deal flow facility, because we're in this together, we're trying to develop the economy together. I'm sure sometimes the banks see businesses that need equity to strengthen their balance sheets. They should be able to refer these to this facility. So I believe there's going to be a lot of success as a result of this facility being established. Thank you.
Just to follow up quickly on that, I think there's been talks that some of the business practices within Uganda are a copy and paste kind of approach from more developed economies, and there is need to have some Africa local solutions that fit our context in Uganda. So what would be we've heard that some of the due diligence requirements are a bit out of context with the type of enterprises that we have in our local markets. What are some of the solutions you would have that you feel would fit our context? What are some of the things we need to change and adapt to the environment that we have right now?
Sure where that view comes from, that it's cut and paste. I'm not a practitioner in this area, but I think due diligence, commercial, financial, technical due diligence is due diligence. It has to be done. There's a lot of behavioral issues that have to be addressed. It's not a cold conversation about, I have money, you need money, you know, do A, B, C, D if you want this money, and walk away. I think there's an understanding that this relationship has to be nurtured, and Richard is the best place to speak about this. It has to be nurtured as best as possible until the business develops sufficient trust in the person who is going to be disbursing this money. There are a few stories out there about, you know, hostile takeovers, etc., which need to be avoided as much as possible. So it's really important that the private equity funds that are identified to finance these businesses also operate professionally and ethically. It's not uncommon in the financing world to see sort of hostile loans, etc., hostile financing mechanisms. So trust and integrity is important, and that's why it's important that we license and approve the practitioners in this area.
I think Keith really knocks it on the head. When you say Africa or some countries in Africa have to adjust their ethics to fit the concept of local behavior, there's nothing as such. I believe that there's practices that are generally accepted in the financial sectors. There's only one way to keep books of accounts. You know, you have the credit and the debit. Now, when some of the prospects we meet start to tell you to adjust your ways so that you can fit into the way they are keeping books, I think that is going to be difficult if you want to accept foreign capital. Foreign capital requires that you adhere known normal practices. IFRS 9 and other accounting principles come into play. So when you find you're visiting Richard and Sons and they're telling you, no, here we do not recognize transport costs, we recognize bribery costs and things of this nature that have no basis for accountability, then that's not where you adjust and say, okay, since they have corruption or bribery in this country, we will bring around, practices that fit that. It just doesn't add. So I think local entrepreneurs, family businesses, SMEs need to be not educated, but brought to book by making them understand how international business is done and what is acceptable and not acceptable. You find, some practitioners in our industry who say, yeah, but that's how business is done here, so we can, let that go. That's not right. And that's up to that individual who has let that happen. It's not a norm. It's not acceptable, I know, and it should not be tolerated. And that's why you find that foreign capital is not penetrating local businesses, because some of these practices are being accepted by some of the professionals, and due diligence fails because of these practices, and then capital doesn't move. It's as simple as that.
Very much. Maybe just to clarify, I think that I wasn't saying that we should be a bit lax on the due diligence requirements, but I was wondering if we can provide, for example, our definition of investment worthiness in Uganda might not be the same definition of investment worthiness in different jurisdictions. I think I just wanted us to have that. We have started our Q&A session, and we do have a few questions that are coming in from the online group. And I think the first question is quite interesting, and I don't know if it's Adolfo or Rashmi who will answer this question. It says, why is DFF focusing on medium and large companies and not the SMEs, which seem to be the most struggling enterprises? And if it succeeds, will there be then a facility created for micro and small enterprises? What informed the decision to come up with this initiative? Or maybe that would be another question. So we could first deal with the first two.
I don't know who made that question, but it was very good. Good question. Well, actually, yes, we know that the need for finance is across the board, from micro, small, and medium enterprises. And yeah, there are different programs already existing in Uganda. There are a number of incubators, accelerators that are supporting companies to access money from different sources, because there are many different sources for companies, especially when they are a startup or they are very small. So you sometimes address the lack of capital from what is called the triple F, family, friends, and fools. Angel investors, sometimes you have some angel investors that support you in the first stage. Microfinance institutions also are doing a lot of work for small companies. So sometimes, of course, we have to think about what is the price of accessing that money, but there are a number of initiatives, programs, incubators, accelerators that are already existing in Uganda. In the case of the European Union, yes, we have some other programs. This is not the only program that we are supporting on the access to finance space. We have, for example, the START facility that supports small companies in the north of Uganda, and the ticket size, the amount of money that those companies are getting, goes from 10K to 100K. So there are different programs. In this particular one, I think that the focus is very clear, and that is also what we have to acknowledge. I mean, we're trying to support companies to access money from capital markets, either private equity funds, venture capital funds, or eventually maybe the stock exchange at some point. So the ticket size of those kind of fund managers is not small. I mean, it's companies that they either, as Rashmi mentioned, let's say an average of 500,000 sometimes can be a bit less, and in some cases it can be a bit more. But yes, I mean, we're looking for companies that can access this kind of long-term capital at a relatively, I would say, mid kind of ticket size. We are not going to very small ticket size because that is a different kind of program, and those kind of programs are already existing in the Ugandan market.
Thank you very much. Maybe just to follow up on that, what informed the decision to come up with this initiative? Where is this idea coming from, and what is the background?
I can take that question. So as mentioned by multiple panelists earlier, all companies need finance to grow. Most companies in Uganda take bank financing, which is short tenor, very expensive, and in the case of Uganda, ranges between 100 to 160% collateral to get that financing. So the focus of the deal flow facility is to help medium to large companies grow and to provide alternatives to traditional bank financing that will then help them expand and create more job opportunities in the country.
Possibly also to add to, that comment is alternative capital is the alternative to commercial capital, bank capital. You find that there's this, the micro and the small enterprises can access all the way from the MDIs to the commercial banks for the kind of capital that is needed to grow them. But then there are medium companies that can no longer access commercial bank capital because of the size of those loans. If you find, for example, a manufacturing company, like any one of these steel companies that require in the tens of millions of dollars, it's going to be difficult for one bank, if not syndicated, to meet the capital requirement of the expansion of that farm. So you find that they could then access private capital from private equity funds and capital markets that is sufficient for the growth. So I think medium enterprises and big enterprises come and access these alternative capitals to be able to access the kind of funds that they would need to scale. I submit.
A quick rejoinder to what has been said by Rashmi and Richard. There are four main stages of a business's evolution. There's the idea stage, when it's still a thought. That's a different type of financing, as was said, friends, fools, and family coming at that stage. Then there's the early stage, when the company is now starting to just build itself up, before it goes into, that's the early growth stage, before it goes into the expansion phase, all right? And then finally it goes into the next phase, where the next big push, where it's now moving from one level to another level. It's not just about expansion, but it's just about diversifying to other markets, diversifying products. So we have to recognize at what stage the different businesses are in the evolution. I don't believe that the deal flow facility is going to be financing ideas. I think that's a different type of financing. To a limited extent, I believe it will be financing the early stage, but mostly it's going to be financing the expansion phase. Where, as Rashmi was saying, collateral is required, where a company might have maxed out on its ability to provide collateral, and yet it can actually raise this funding. Thank you.
Hi, Jackie, do we have a lot more questions or can we wrap up?
Some of the questions being asked have already been discussed, but it's possible that maybe some of the participants joined a bit late. So I think it's okay if we just reiterate some of these things. There's a question to CMA to say, how does the deal flow facility fit into the 4-year strategy that was launched last week?
I think the quick answer is that it is a matchmaking facility. It helps prepare businesses to access the growing pools of savings out there. And our ultimate interest is to see a meaningful contribution by the capital markets, within the capital markets ecosystem, to finance business growth. So I think it's well suited to doing this.
Question still, I think this was mentioned earlier, but they're asking, many deals or facilities, many facilities of this kind have been set up and launched. How different or how special is the DFF?
Let me take on this one and then maybe continue. I think I mentioned it somehow before. I'm not sure that there is a facility that has been set up in Uganda that is actually focusing on supporting companies to access private equity fund. The whole idea of the deal flow facility came from actually the Capital Market Authority. I mean, they identified the need for this kind of facility a number of years ago. And maybe we have to be aware that to reach this point of actually setting it up and supporting it and funding it, there was a feasibility study that was done. We tried to check also what is going on in other countries in the region. I mean, the feasibility study also went to Kenya to analyze what is going on there, Ghana, etc. And as we have been mentioning during today, I mean, there are a number of challenges on being able to deploy this capital. The capital that Richard was talking about that has been growing sixfold in the last years. You know, you have issues from origination, meaning that you have to deal with informal companies. And of course, being informal has advantages. I mean, sometimes you are informal, you don't have to pay taxes, etc. But being informal also has disadvantages because you are not able to access certain amount of capital, certain quality of capital. So we have issues on the origination, meaning the kind of companies, the number of companies that private equity and venture capital can deal with. So we're trying to address that. We're also trying to address the issues of how to decide investments in those companies. Investments means, in many cases, you need to do evaluation of the company. And how many times we had an issue because companies that we want to invest in, they don't understand what are the different techniques for valuation. And then you end up a company asking for 2 million for X amount of shares, but actually when you do different valuations, maybe the value is even half or less than that. So you end up getting stuck there. You cannot move. Some people think that their companies value so much and it's actually not value so much. So that is another issue that we're trying to address. Skills. I mean, when it comes to investments, I mean, investment analysts, we have more and more in Uganda, but 6 years ago there were very few. So it's an industry that we need also more skills, we need more people prepared, we need more people with experience. And then, of course, when investors, they have to exit from company, we again have a number of challenges. Normally, in a well-developed market, you have a secondary market that you can get out and your investment goes, for example, into the stock exchange and then you can easily exit. Sometimes here it's not easy to exit from investments. So all these kind of issues we're trying to address through this facility. And I have not seen that in Uganda before.
Thank you very much. I think those are the questions that we have received so far. I will ask all our panelists to give a parting thought, but I think some of the things that have come out clearly is that there is need to build capacity of enterprises to develop and develop a supportive ecosystem which empowers the enterprises to succeed. We've also spoken about the need for softer reforms, if I must say, and initiatives in form of enhanced advocacy, awareness raising, and information sharing. And we need to come up with market building approaches and recommendations for consideration. I know that some of the challenges cited above appear to be daunting, but I'm sure with partnerships and with support of development partners like the EU, I'm sure we can come up with fit for context solutions for our market. I will ask, starting from my extreme right, Richard, if you have any parting thoughts, if there's anything that maybe other questions that you wanted to comment on, please. I'll just give us, I think, 2 minutes for all of us to wrap this up.
Thank you, Jackie. First of all, let me thank Rashmi, Keith, Adolfo, and yourself, and Ruth, who's probably still online, for your submissions. I think you go a long way of explaining where we are in terms of accessible capital in Uganda, and you go a long way in explaining what's available for entrepreneurs out there, what they need to do to access this capital. You'll be surprised that you meet big, medium companies that still don't have an idea of how they should set up in order to attract capital. And they're doing well, but they're not normalized. And if you can get them normalized, then they can access this capital. And by normalization, I mean they need to follow acceptable ways of doing business internationally. Once that is done, we're going to see a lot of capital coming into this region and this area. And what we can say to them is that we're here. There's no such thing as a small, stupid, or useless question. Reach out to us through our Twitter handles, through our emails, websites, and any form of contact, and we'll answer the questions that you have. We remain available even after this forum. Thank you, and I submit.
Thank you very much. I'll ask Keith to give his parting thoughts.
Thank you for a wonderful session and for finally us getting to this point where we are launching this facility. I think there's a tremendous commitment from the government, from the Ministry of Finance, to develop the financial sector. There's a financial sector strategy in place. There's a financial services department that has been established in the Ministry of Finance. There's a lot of interest in seeing alternative forms of funding the real economy. So I think this comes at a very good time for businesses. There's so many businesses out there with potential to grow with all this unlocking of regional markets. So they need to really prepare themselves for growth in every way, and they cannot continue relying on only bank financing. And I've had many businesses complain about interest rates. Obviously, short-term funding has its constraints. Interest rates wouldn't even be a problem if the capital that was available was more patient. The young population out there, young professionals whom I want to encourage to join the industry. We need more foot soldiers to knock on the doors of these businesses and raise awareness. So these foot soldiers need to be informed. The capacity needs to be built. There's a growing fintech sector, crowdfunding, and other forms of mobilization of capital that are growing and becoming a lot more prevalent, peer-to-peer lending. So there's so many things happening in the financial landscape that we want to see the deal flow facility take advantage of. So the challenge really now is even investment clubs. I forgot to mention investment clubs. There's so much capital under investment clubs that is typically invested in traditional passive assets. We need to see this capital put to more active use in businesses. Yes, there's some risk, but also huge returns that can be made from investing directly in businesses that are exposed to regional and African-wide markets. So I think the scope of work for the deal flow facility is cut out, and we just look forward to supporting them as much as possible, and we look forward to the results. And my plea is that it will be as practical as possible. The economy needs to see deals closed. Yes, analysis has to be done, but I just appeal to the guys who are running this facility to make it as practical as possible and as safe as possible. Thank you very much.
Thank you very much. I will invite Ruth, if Ruth is still online, to give her parting thoughts, just a minute or two.
On behalf of the private sector in Uganda, I have to say it's been an opportunity for us to be able to be part of this event. We wish to congratulate FSDU, the Capital Markets Authority, and also appreciate the support that the European Union is putting into this. We do believe that this funds flow deal is going to address the issue of access to long-term financing for both medium and large and small enterprises in this country. And as PSFU, we want to assure you of our commitment that would be able to be available and encourage the private sector to be able to fully appreciate on this. And also on the other hand, as being members, as PSFU being co-chairs of the SB4U, we will be able to take an interest in monitoring the progress of this initiative. Thank you very much and have a nice day.
Thank you very much, and thank you, Ruth, for staying online for this entire period. We truly appreciate you. I will ask Rashmi to just give us her parting thoughts and next steps. Where do we go from here?
I just want to reiterate what my fellow panelists have said. 40 deals, 5 years, 8 deals per year. How do we get there? And we are looking at 100 companies match made at least. One of the key routes of getting here, as everyone has already mentioned, is strong partnerships. How do we get enterprises to join the facility? How do we get investors to join the facility? How do we make these enterprises attractive? So we're hoping that we will sign some institutional partnerships with PSFUs, because that's where all companies are under, this umbrella body. We hope that Richard will help us in signing MOUs with IWACA. We also hope to sign them with the Africa Venture Capital Association. But I also think that there is a larger responsibility on all of us in educating companies on the importance of alternative sources of capital. It benefits venture capital associations because they're able to prove that there is a pipeline in certain countries, and there's an expansion of that pipeline, and it benefits their members because then their capital can move. And it benefits umbrella bodies like PSFU because they're able to provide value to the enterprises and memberships that they have. The deal flow facilities is a matchmaking between the likes of PSFUs and their members and the likes of the East Africa Venture Capital Association, the Africa Venture Capital and PE Association, and their members. And we hope to, as Keith mentioned, ensure maximum number of deals feasible in the next 5 years.
Very much. I will then ask Adolfo to wrap this all up.
Yeah, thank you so much. I think I started the panel talking about the amount of money that needs to be mobilized for investments in general, and also for creation of jobs. So this is actually one of the programs that we are supporting to do that, because we have been talking about alternative finance. Different way of getting finance for companies from the traditional banking sector. The opportunities are high. There's so much money actually now being ready to be deployed when the companies know how to deal with this kind of money. So this is actually the objective of this facility, and then we will be looking forward to see all these different kind of strategic linkages between the project itself, the private sector foundation with the number of companies that they are members of the umbrella organization, of course the East Africa Venture Capital, because they are the ones that have the contacts with the fund managers and the different investment funds. So this is going to be a kind of linkage between different companies and investors, and that is what the facility wants to promote. So looking forward to see the outcome in the next years, and yeah.
Thank you very much. I think we can all agree that this has been an excellent discussion. I would like to take this opportunity to thank all the panelists for taking the time out. We know this is quite a challenging situation. I think one of the issues we didn't discuss, but maybe we will take that offline, is about how the DFF fits into the pandemic situation that we are facing right now, but we can have that offline. But thank you very much, Richard, Adolfo, Keith, Rashmi, and Ruth for joining us for this panel. I will ask Diana to take us to the next session of this discussion. Thank you.
Thank you for that, for the very engaging panel discussion. I hope my microphone is on and you can hear me clearly. So, as Jackie said, I want to reiterate our thanks as FSD Uganda to the panelists who joined us here today and shared quite a few useful insights on the role of long-term capital access to the growth of medium and larger enterprises in Uganda. I want to thank the online audience as well who listened in for the entire morning session and who shared the thought-provoking questions, which I believe have been very aptly addressed by our panel. We are now at the very near end of our program, and we have a small signing ceremony. But before we do that, I am going to request the panelists to kindly take their seats, and I will request the FSD Uganda Executive Director, Rashmi Pillai, to come in front and share a couple of comments on this partnership. Welcome, Rashmi, and thank you, panelists.
All right, good morning, ladies and gentlemen. Once again, thank you for joining us here today to hear more about the partnership with the Deal Flow Facility that is aimed at putting Uganda on the map for non-bank financing that fuels the growth of the private sector. I'll try to be brief in my remarks so that we can get to the exciting part of the signing. I want to acknowledge the following people whose efforts have ensured that we are here and we are a success. Representatives from the European Union, Ms. Caroline Adriansen and Adolfo Alonso from the European Union, Mr. Keith Caligira, the Chief Executive Officer of the Capital Markets Authority, Ms. Ruth, Project Director, PSFU, Mr. Richard Mugera, Ascent Capital, and also here in capacity as a steering committee member for the East Africa Venture Capital Association, our colleagues online, our colleagues from the press. You're welcome to the launch of the Deal Flow Facility. Ladies and gentlemen, a vibrant private sector, as we heard in the panel today, is key to opening new livelihood opportunities, creating quality jobs for the educated, youthful population, and facilitating the transfer of knowledge and skills. A private equity survey conducted by the East Africa Venture Capital Association and KPMG for periods between 2007 to 2018 highlighted an estimated 6.4 trillion worth of private equity funds had been raised globally, with US $33.1 billion earmarked for Africa and 3.3 billion specifically for East Africa. Reports from the Africa Private Equity and Venture Capital Association have shown a strong correlation between PEVC financing and job creation. In the year 2016, when data from 199 PE companies were analyzed, the net increase in jobs was about a 15% growth, around 10,900 jobs. However, the largest flow of PEVC funds and other types of non-bank financing go to some of the key hubs on the African continent. These hubs are South Africa, Nigeria, Kenya, and Egypt. While the flows into Uganda have increased over the years, we still lag behind our neighbors. One of the key drivers of this phenomena is the number of investment-worthy deals for PEVC firms. The deal flow facility has been designed to address this root cause problem. The deal flow facility arose out of the collaboration between three institutions: the Capital Markets Authority, the European Union, and FSD Uganda. The primary objective, as you've heard from the panel here today, of the deal flow facility is to increase non-bank financing into growing and scalable Ugandan businesses. Over the next 5 years, we hope to matchmake 100 Ugandan businesses to various investors and eventually resulting in 40 deals in 5 years. The finance can be in the form of any equity, debt, commercial paper. The facility is not tied to any one sector or any one form of financing. The DFF, or the Deal Flow Facility, which is part of CMA's 4-year strategic plan, provides an opportunity to implement the roadmap for achieving frontier market status for Uganda and attract foreign investors. The facility will increase investment in medium to large companies in Uganda by helping them become investment ready, by providing business development services to at least 220 high potential companies over the next 5 years. These companies will be encouraged to put in place adequate governance, accounting, operational structures that guarantee their growth and scale, and more importantly, formalization. The facility will look at plugging in the access to finance gap for these companies, and with especially companies that have the potential to absorb $500,000. One of the secondary objectives of the Deal Flow Facility is to address another market issue: stitching or weaving together a fragmented market ecosystem. To have a deal go through, both investors and companies need the support of transaction advisors, lawyers, tax advisors, but the cost of delivering these services to companies is prohibitive. In fact, at times it can be unviable to get much required professional help depending on the size of the deal. The DFF aims to be a central focal point for all of these ecosystem players to reduce the cost of finding new deals. Additionally, we hope to partner with key industry associations like the Institute of Chartered Accountants, the Uganda Law Society, and others to build the capacity of their members and increase the flow of quality, reliable advisors at an affordable fee to high-growth companies in Uganda. Today, we heard from Richard, who's a representative of the East Africa Venture Capital Association, Keith, who represents CMA, Adolfo, who represents the EU. And we've learned a lot about the challenges facing medium to businesses in Uganda. We've also heard from Ruth about the non-financing challenges that businesses face. The Deal Flow Facility will focus on one of the legs of that challenge, which is making companies investment worthy. Historically, episodes of severe economic, let me also say that one of the challenges that the panel was not able to discuss was the challenge of COVID and how that has impacted companies and their revenues. We have seen an aggregate decline in demand. We have seen companies take in losses that they were unpredictable and unusual in nature. But many of these companies have very strong fundamentals. Despite these challenges, we did see PEVC deals go through last year during a pandemic, and we hope that the PE and VC Industry Association will continue investing into strong companies in Uganda. But looking forward, FSD Uganda is prioritizing programs that create direct links between the role of the financial services and the real economy. At FSD Uganda, in our new strategic period that begins in 2021, our work will additionally focus on portfolios that promote the economic mobility and quality of life of our target beneficiaries. Our strategy is closely aligned to the country's national development plan, and we are excited to be part of this facility and implement it with like-minded partners like CMA, the Ministry of Finance, our current donors, the European Union, UK Aid, and the Bill and Melinda Gates Foundation. It now gives me immense pleasure, before we go to the signing, to invite the EU representative to say a few words.
Thank you, Rasmi, for the nice words. Well, let me start similar to the way we started the panel. The deal flow facility is trying to address the issues of investments and creation of jobs in Africa. So, in the framework of the Agenda 2020 Sustainable Development Goals, to actually achieve investments and creation of jobs, we cannot get stuck on only just mobilizing government, public money, or development assistance money from development funds. We have to go one step forward. And the step forward is to mobilize private sector investments, private sector capital that will allow mobilization of those resources, but also create jobs. So that is what we are trying to do with this one. And it has been, I think, a long road to achieve that. Of course, the first step was, I would say, the Capital Market Authority identification of that need and how they have been actually trying to find ways to set up a facility of this kind. The second step, of course, we needed somebody to take this challenge, and that challenge has been taken by the financial sector deeper in Uganda, and thank you for that, because it's not easy to take this challenge, because you have always those kind of question marks. What will happen if money actually is not deployed to companies? Who will be blamed, actually? So thank you for FSDU to take that challenge. And all of this is in the framework of Sustainable Business for Uganda. Sustainable Business for Uganda platform was set up officially in March. It's composed of private sector, Ugandan private sector companies and European Union institutions, plus the government of Uganda, trying to actually mobilize capital for those companies. We have been working since then in a number of challenges for the private sector development. It was skills, corruption, access to finance. On access to finance, we also have been supporting the development of the banking sector with different programs. We have some programs with Uganda Development Bank. We have some programs with the commercial banks. But this particular one is trying to support access to finance for capital markets, either stock exchange listing, but mainly private equity, venture capital mobilization. And that is what we're trying to address. So the facility will support companies to move from informality or eventually accessing capitals from family, etc., will move into trying to access capital from private equity funds. And that requires a lot of support. That requires a number of technical assistance to those companies, and it also requires proper linking with proper institutions, proper funds, and that is what the facility will do. So we're looking forward to see the outcome in the next years. This is actually, I would say, a mid-term program of 5 years, so that we want to allow the facility to grow, to be able to employ the right people, to be able to create those linkages, and eventually to be able to see those number of companies that we expect them getting the amount of money that we want to mobilize. So without any further words, I say wishing the best for the facility, and yeah, thank you very much.
Thank you for that, Rashmi. Thank you, Adolfo. And we've come to the tail end of the program. We are going to end on a very high note. I'm going to ask the representatives from the key partner organizations. Adolfo, I'll ask you to kindly join us on stage. Off to my left. Keith, I'll kindly ask you to join us as well on stage, and Rashmi to sign the agreement that's going to signify the beginning of this partnership that we are going to be working over the next few years. So kindly take your place on the panel. You have your partnership agreements in front of you. I'll ask you to kindly sign them and pass them down for the next partner to sign, and then we'll welcome you to the front for a brief photo op. Thank you. Thank you. I think that deserves a round of applause from the room. Thanks for that. Now I'll kindly ask you to hold your partnership agreement and join us in the front for a very brief photo op. And that will signify the end of today's program. Once again, ladies and gentlemen, thank you everybody who was able to join us physically here today. Our guests online, we thank you for your participation and active discussions. Welcome to the partners. Stella, I'll hand over to you. Where do you want us to stand?